In this video, we are going to talk about how to calculate value at risk using uh, variance-covariance approach and historical data approach. So the data required for this tutorial is provided in Excel sheet. So we assume that we have got a fund, the value of 100 million, which is actually equally divided into 4 stocks. So looking at the Excel sheet, we have got index, which is S&P 500. Also, we have invested in Apple, J&G, Microsoft, and Kodak. So the last 5 years monthly, daily data is gathered here. So we are interested to calculate the value at risk, the daily value at risk for this fund. And as I said, we assume that the fund 100 million is equally divided into 4 stocks. So in the first step, we are going to compute daily returns for the 4 stocks and index, and also provide a table with summary statistics for the 4 stocks and index returns, and compute the 95%, 99% value at risk of your portfolio using the variance-covariance method. So this video is allocated for these 3 tasks, and the next video we go for further tasks. All right, so let's back to the data provided in the Excel sheet. In the first step, we have to estimate the return and daily return of this series of data. So let's do that. I'm going to put them in the green color. So the most straightforward way for estimating daily return is the price today minus price the day before over price the day before. So we have got minus 0.0011. We can convert it to percentage and increase decimals to have a better view of our return, and then control, basically double click and copy down, and also copy to the right columns. Again, we can double click here to have the daily return of our series. So that's the first step is done. What we are going to do now is to provide a table including the summary statistics of this series. So what I'm going to do is to go to data and click data analysis. So if you don't have this option in your data, you have to go to the files, options, add-ins, click add-ins here, and then manage Excel add-ins, press go, and you need to tick. If this box is unticked, you need to tick analysis toolbar, press OK. So back to the data in your menu bar, press data. You should see data analysis here. So click. And now we are looking for analysis tools. We are looking for descriptive statistics and press OK. So we are going to select input range. So I attached the name of each series. So it shouldn't be any gap between the percentages and the name of series. So what I'm going to do is to select all these series. Basically, I'm interested on index, Apple, J&G, Microsoft, and Kodak. So I select them then Shift Control press arrow down at the same time. So I select all this data, and then I go to output range and select the output, which is a random cell where I like the data and final results be shown there. Also, I need to select summary statistics. So I tick summary statistics and press OK. All right, so it says that the input range contains non-numeric. So let me select from here. I'm not going to select the names this time, and everything else is the same. So let's press OK. So as you see, we have got the column 1, 2, 3, 4, and 5. Since I like to show the name of each column, so let's back to the data analysis, descriptive statistics, select the range. I want to select all these names, Shift Control down, so all the data series are selected. And as you see, there is an option here in this box, labels in the first row. So I click this one, output range is the same, press OK. So this time I have got the names as well. So as you see, we have got different statistics for our cities. So to make it look better, I'm going to drop the title of statistics because we have got them here for the first one. So we don't need to repeat it again. So this is for index, followed by Apple, J&J, Microsoft, and etc. And simply, this is the table which represent the descriptive statistics of our series. Okay, so the next step, as it's asked in the this practice, is provide a table of its summary statistics already done. Compute daily return for 4 stocks. We did it. So now compute the 95%, 99% value at risk for your portfolio using the variance-covariance method. So remember that for estimating the variance-covariance for our portfolio, we need basically a couple of information. So these 4 stocks are available in our portfolio, and we have got their average return, daily return. We have got the risk, which is the standard deviation, and we have got the rate. All right, so the return is already calculated here, so I'm going to use it. So see, mean stands for return, so is equal to that one. So the return of Apple is here, so I'm going to put here and copy to the right. So we have got everything copied. Standard deviation is also estimated, standard deviation. So again, standard deviation of Apple. So copy to the right, and the rate is given by the task is 20%. So we assume we equally invested in these 4 stocks, so each 25%. You can change the format to percentage to have a better, nicer look. Okay, so we have got the table which is required for estimating value at risk. Plus, we need variance-covariance matrix, which represent the variance of each item and the covariance of them together. So to estimating variance-covariance matrix, again, we can go to the data. We have got data analysis. This time I pick up covariances. So it asks me for input range. So I'm going to select input range again. This time we just need the input range of the stocks in our portfolio, no index. All right, and select all of them. Right, let's back up, and the output range is going to be here, and label the first row same as before. So we have got variance covariance matrix. Remember, the elements or numbers in the main diagonal of this matrix represent the variance. So we have got the variance of Apple, and if you check, it should be same as this one here. If you have got variance, yes, sample variance. So we have got here 1494. Sorry. Yes, it should be, yes, yeah, 3580, right? So this number is exactly same as this one. And this is the J&J variance, Microsoft variance, and also Kodak variance. And this number represent covariance between J&J and Apple, right? How these two move together. So this number should be exactly same as this number, right? The covariance between Apple and J&J is exactly same as covariance of J&J and Apple. So I can put this one equal to this one because I need to complete the variance covariance matrix for my propose. This number should be exactly same as this number, right? And this number should be exactly same as this one, because again, the variance of Kodak and Apple is equal to variance of Apple and Kodak. The same logic, this one is equal to that one, and this one is equal to this one, and finally, Kodak and Microsoft. So now we have got variance covariance matrix. So variance covariance matrix is given. We have got the three matrices basically here. The matrix of returns, number one. I'm going to show it by another color. So we have got matrix of return here. All right. Well, let me change it to blue. We have got matrix of risk. I'm going to change it to green or red. And we have got the matrix variance covariance matrix. So I'm going to change it to, let's say, green. And also we have got matrix of weight. So I'm going to change it to, so we have got 4 matrices. And the dimension of each matrix, this one is 1 times 4, because we have got 1 row, 4 columns. This one is 1 times 4 as well. This one is 1 times 4 as well. And this one is 4 times 4 because we have got 4 rows, 4 columns. All right. So now we want to calculate portfolio, return, and risk. All right. So we are focusing on our portfolio. You know, the return of portfolio is the weighted average return of individual stocks. All right. So here we need to take into account 2 matrices, matrix of weight and matrix of return, right? And always, we need to take into account the rules for multiplying 2 matrices. And remember, we said that if you want to multiply matrix of weight times return, basically the number of rows of the first matrix should be same as number of the columns of the second one. Okay, so return basically is equal to what? Is equal to weight times return, right? Matrix of weight times return. Matrix of weight in our case is 1 times 4. All right. So matrix of return is also 1 times 4. So in order to multiply these two, I'm going to use MMULT or M multiplication is a function in Excel for multiplying 2 matrices. So array 1 or matrix 1 is matrix of weight. So I'm going to select that one. So I see it is 1 times 4, all right? The second matrix, matrix of return, is also 1 times 4. So I cannot multiply them now. So what I'm supposed to do is to transpose it to a matrix of 4 times 1. So when I say transpose a 1 times 4 matrix, it gives me a 4 times 1 matrix, right? So in that case, I can multiply them. The same logic for the risk, okay? So when you want to multiply two matrix again, the number of the rows of the first matrix should be same as number of columns of the second. So for the risk, we have got a little bit more complicated stuff here, right? So matrix of risk, basically the risk of portfolio, we need to multiple weights times basically a standard deviation, variance-covariance matrix. Variance is actually is a multiplication of 3 matrices. Matrix of weight times sigma, which is the variance-covariance matrix, and times the transpose of the weight matrix. So remember, we need to follow this. So W is 1 times n matrix. Again, dimension is 1 times n, 1 row, n columns. And sigma is n times n matrix. So this is a square matrix, basically. It has got n number of assets, right? So we have got n times n matrix and 1 times 4 matrix. So to multiply this, we need to remember, to calculate the risk of portfolio, we need to multiply 3 matrices. So we follow that. M mult, the first one is matrix of weight, 1 times 4. And the second one is the matrix of variance, covariance matrix, basically. So that one. But now we should multiply the result to the third one. Remember in Excel, M mult or M matrix multiplication function can just multiply 2 matrices. So we need to we need to use another M mult here to multiply the result of the first operation times the third one. The third matrix is the transpose of the matrix of weight. So transpose matrix of weight. So we have got a matrix of 4 times 1, right? So we have got the result. So I'm going to change them to percentage again to have a better view. And this is the risk and return of our matrix. Next, we are going to calculate value at risk. Value at risk in the level of 95%, or value at risk of 5% significant level, or 95% confidence level, right? So it's like equal to the formula, remember from last tutorial video, you can follow it if you like, is equal to expected return, or the return of our portfolio, plus norm S inverse. So normal standard distribution, the inverse value of normal standard distribution in the 5% significant level, times the risk or standard deviation of our portfolio. By the way, just forgot to say that this number is a variance of portfolio. We are interested in a standard deviation, so we need to do a square root of this value. Now we have got accurate answer, which is the risk of our portfolio measured by standard deviation. So let's do it again for VaR. So it's return plus norm dot S inverse in the level of 5% times the risk of portfolio. And this is the value at risk in 5% level. What this number tells us, it tells that with the probability of 5% maximum loss would be 5.29, or it's just 5% possibility that maximum loss should the loss be more than 5.29%, or with the probability of 95%, the maximum loss would be 5.29%. All right. So that's what we are interpreting from this number. Value at risk, again, value at risk tells us what is the actually maximum loss given a percentage chance in 1 day or in a period of time. Here, our frequency of data was 1 day. So this is a daily value at risk, is 5.29%. The value of our portfolio is 100 million. So we can find the equivalent dollar value, which is equal to this one times 100 million. So value at risk, the 5% level is $5.29 million.